Good afternoon, everyone. I'm Lisa Kutoa. I head up STC.UNM, and I'd like to welcome you to the seminar today and introduce our speaker, who is Professor Craig White. And Craig is a longtime UNM faculty member. He's also held several positions as Dean of Anderson School. He's been our Executive Vice President for Finance and Administration. So he's held several administrative positions as well as his faculty role. His background is in tax and accounting. His training, bachelor's, master's, and PhD degrees from Texas Tech and Texas A&M. He's also worked in public accounting before that, before he got his PhD. So his expertise really spans the gamut from startups and corporate tax, corporate structure, startups. He's been on the SCC board for a number of years, so he's pretty familiar with the startup ecosystem as well. So very fortunate to have you here today. Thank you, Craig.
Thanks, Lisa. Well, thanks for giving me a chance to come speak. And thanks for all the help showing up. So what I want to go over today is some ideas around cash flow. I'm talking about cash flow budgeting to start, and then I'm going to just give a really brief overview of some of the tax considerations of different business entity types that you might run into as you are starting your business, or as you maybe already into that process somewhat. And then along the way, and maybe definitely in conclusion, there's a couple things that I'm just really interested in now that might also be helpful to you. And in particular, what I'm talking about is qualified opportunity zone. Just out of curiosity, how many of y'all heard of that? That's good. Probably about 40%. So we'll talk about that in terms of its interaction with the general tax concepts and some of the new possibilities that are afforded by that. And I'll mention as well qualified business income, which again is a new tax provision that's meant to help businesses in general, businesses, startups in particular. So along the way, if you have any questions, please feel free to stop me. I'm going to do this kind of old school, no PowerPoint. Hope everybody's okay with that. I'm going to do like some notes up on the board. And if you have any, I was thinking about this, kind of takeaways are always useful. So if you have any, I've got these notes. I can email them to Lisa, and maybe we can send them out. If anybody would like a copy of some of these I'm going over today. Okay. So to start with, I want to talk a little bit briefly about pro forma financial statements, and use that as kind of a generic discussion to get into, and then we'll talk about the tax topics in particular. Where this is coming from, this is a class we used to do over at Anderson a while back to our executive MBAs. They had a project where they had to come up with a business plan to start a business. And we had different components, and this is the part that I talked about with pro forma financials, and then the tax aspects of starting that business. So I don't have a lot of time for the whole thing, but I want to give you a little bit of a brief primer of those aspects. So starting off with pro forma financial statements. No hard and fast rules here, but what I would recommend is something around like maybe 2 to 3 years of an estimate going forward in terms of what you can expect in terms of what you need in terms of assets. Out of curiosity here, I just want to kind of gauge a little bit about the level. How many of y'all are familiar with income statement, balance sheet, cash flow? Okay, awesome. So that makes life a lot easier. So if we're talking about the balance sheet, estimating as you look out, as you're planning the business, what are you going to need in terms of the property, plant, and equipment, the resources? Where is it initially going to come from? And then on the other side of the balance sheet, looking at the liabilities and the equity side. So how are you going to finance it? Is it going to come from debt? Is it going to come from your own resources in terms of equity? If you're going to get it from debt, I mean, how are you going to be able to do that? What's your possibilities of doing that? What are you going to have to be able to show? So just that sort of planning and thought process in terms of what's it going to require to get the business started from a capital and infrastructure perspective. And this is going to vary, obviously. This is a good practice in terms of thinking through what you're doing in terms of your business. It's going to vary in terms of what you're thinking of doing. So obviously, if you're thinking of doing something more, say, like on a consulting basis, that may not be as asset intensive as if you're planning on starting a coin-operated laundry or whatever you're thinking about. You know, the different ways in which what's going to generate your revenues. Is it going to be equipment and property, or is it going to be more of the intellectual property and your time that you're putting into it? And that is just part of that thought process. It's going to have implications about your funding and what you need. The income statement, that same idea over 2 or 3 years, estimating out what you expect your revenues to be, what's realistic, and even maybe more so, this is the basics of the income statement. Your revenue minus your expenses, coming up with some estimates around what that could be expected to look like. And very importantly, the timing of both of these items. In terms of when can you expect to be getting dollars in the door coming in versus, you have directions on this, right? Good direction coming in, bad direction going out, right? Versus the expenses when you're expecting, when are you have resource flows going out the door? Because that, again, this is just a discipline in terms of thinking through this process of what you're likely to need and the timing. So, for instance, from this process, and just employing this discipline about thinking about what's likely to happen. As you project out your revenue and expenses relative to your asset needs, are you likely, in your term of business that you're interested in, is it likely to be seasonal, for instance, where you might be bunching, the revenues given a certain period of time, but the expenses, say, may be more pro rata over the course of the whole year. Does that kind of make sense? And that's part of what you're doing this for, is it's mapping this out. So if you have seasonality in the business, and if you're mapping this out, one of the things that would be helpful to be able to identify is periods of are you likely to run into a cash crunch? Whereas you look at that relative to your balance sheet, how much cash do you need to have on hand as you draw that down relative to your expected inflows and outflows, so you have enough cushion where you're not endangering your whole business, or if you have some employees, payroll, all these things that you have to be able to come up with the dollars to fund, thinking through that more on the front end. So this would help in that sense as well, as you look at this from a expectational standpoint, looking at your pro formas. A couple of things relative to this, just some thoughts out there. Over time, I mean, granted, as you look 2 or 3 years out, as you increase the time frames, you're looking farther out. As you're looking at these estimates, obviously your uncertainty kind of goes up. Well, not kind of, it just does, right? Because it's hard to foresee the future in any case. The longer horizon that you're looking out, the more uncertain things are. So you're kind of taking that into account in terms of how you split this up. So like in year 1, maybe you do this maybe you're looking at this monthly year 1, where you have a little bit shorter time horizon and visibility as the potential outcomes. As you get farther out, maybe year 2, We estimate this more on a quarterly basis, which is kind of reflective of a realistic time frame in terms of being able to measure or expectationally where things are going. And maybe even year 3, you do a quarterly, or you do it maybe on a semi-annual or annual basis in terms of this. Again, because you want to take into account some granularity in terms of how you're looking at it, but also some margin for error. Right? You don't ever want to be taking on too much risk because you're being too optimistic about the potential outcomes. Does that make sense? So that's some thoughts here on this. One last thought on this, and then I'll maybe see if you have any questions or thoughts on this component of the talk. In terms of certainty, so this kind of all falls under the big topic of risk, right? When you're talking about certainty and uncertainty. Starting a business, that's inherent part is risk, right? Hopefully you're getting an expectation of return that's commensurate with the risk, but you expect to be making enough rate to reward yourself for that, or whoever's loaning your money, or the equity holder, so forth. But in terms of risk, the uncertainty regarding these two sides may differ. In fact, it probably will. So as you think through this process and you're making these estimates, I would argue that you probably have a better idea of what your expenses are going to be than, say, your projected revenues. Question?
I'm a consultant.
Uh-huh.
So I've spent 3 years developing the business. No income yet. I'm almost there. I'm almost to the point of being able to market what I developed. Should I have been keeping these records? I mean, right now it's my home internet and me, my brain, and that's it. As far as cost.
Well, I think should you, that's a normative question, what's it mean, should you?
But I mean, I think it applies to several others I see in this room that I kind of know a little bit more about their business than you might.
Well, I think it's a great question and a great point. And I would kind of frame this in terms of risk. That's part of the reason starting out with the balance sheet. Because, it's what you're saying there. You're working from home, you're putting in your own time. I don't know, maybe you've got some other revenue coming from something else, from another job.
Yeah,
so that speaks to the level of risk that you're taking on in terms of setting up that business. Now, if you're looking at a different type of business, I was mentioning in the front, like a real capital-intensive business, that could be driving a lot more on the expense side, which would necessitate an even greater granularity when you how likely you are to be able to obtain those resources to begin with, right? Whether it's doable.
Maybe 3 years of expenses is about all that I really would want to worry about.
Yeah, I
My
think.
launch in 2020.
Well, and I think in your case, I don't know about your business, but I think it's a good case point on this. Is if you're looking to shift gears from where you are now into a higher gear because you're now to that point, well, then you have to say, okay, what's going to be the delta between where you are now and where you're going? Sort of like, what are you going to need? If you're shifting into a higher gear, is that going to change, expenses, capital requirements, and so forth? Maybe it does. Or maybe it shifts, I didn't write down here, but your profit expectation. Because if you're shifting your time where you're really relying on that to fund your life, that's kind of definition of risk, right? How much are you putting out there in terms of how much you need to rely on these outcomes? You have a question?
I had just a quick question for you. I was wondering if it was based on your experience in accounting and finance, was it a conscious decision to use red ink?
To use red ink? No, that's a good question. I get out of this class I teach earlier in the morning, and about 90% of the times the markers don't work. So the first one I grab that works is the one that I'll use.
I wonder if that's fake.
But yeah, maybe it's fake.
Predetermination or something.
I should erase this one. I think I've got a black.
Uncomfortable when you use red ink.
I've got a black one. I could switch into black. That'd be a little bit better.
No, but I think it's perfect because
I think it's very appropriate.
No, but when you're starting out, all of these are the concepts that I've heard them over and over from people that are really hardcore understanding accounting of a business. Yeah.
Yeah.
The facts of life, basically.
Well, and it's, yeah, it is. I mean, I'm obviously biased as an accountant, but that's the language of business, flow through to understand that about where the resources are coming from, how they're going to flow through the business. Yeah, we've been working in Anderson over the years, and Lisa's been involved this way, our business plan competition. The ones where the students are judged in terms of what we're putting together, where there's usually the biggest gap, is in the financial statement area in terms of the projections. And really that thought process as to what's needed and when and what's realistic, what this revenue ramp up looks like, you know, that sort of thing is really where it needs really a lot of thought and work.
If you had to, I know all these things work together and they're all very important. And to me, they're flowing. You need to revisit them frequently. But if you had to pick just one form of data or one statement, if you will, to help you manage and grow your business, what would you pick?
Well, that is a great question. Thank you, guys. I'm glad you missed it because that's a point I definitely wanted to make. Of these three, what I would say, and they do all integrate together, is that one, cash flow. Is looking at it on a monthly, quarterly, annual basis. Talk about potential cash crunch. I mean, that's what you could use as a tool to help identify what do you expect your low point in cash to be? How much cushion do you need to account for uncertainty in that realm? You know, does that affect seasonality where you could have a mismatch? What's that mean in terms of your required funding? Do you need to get a line of credit available or something else where you can access resources for periods of time where you may not have the revenue coming in? So I would say definitely the cash flow, because that's one of the biggest risks to the startup business is, are you going to hit the wall in terms of cash availability? You know, it could also go to your financing. I mean, when are you going to get equity financing? When are you going to be able to attract more debt, your own capital if you're putting into it? Is it coming from sales? So really focusing on cash flow and expectations around that. Other questions or comments on this general thought on the pro formas to begin with? Okay, well, seeing none, I want to shift gears, and I want to shift into the tax side of things. You're making me paranoid. I gotta switch colors of ink. I'll go totally to black. I'll go to blue. Something neutral, but not red. So I'm titling this tax implications. Really what I'm going to talk about is different tax structures and in terms of entity choice. I've got a couple of links. I mean, it's kind of hard to write them up here, but I'll put them in materials to see if we can get sent out to everyone. Just to let you know what I can send out to you. I've got the link to the New Mexico Secretary of State's office. So I'll get that to you. Well, what's on there is instructions on how to set up these various types of entities and what the rules are regarding that. So for instance, I'm going to be talking about limited liability companies, C-Corps, S-Corps, sole proprietorship. All the doing business rules are located at the New Mexico Secretary of State website. So I'll send that out and then it'll be dispersed to you all. And then I've got another thing that I found useful over the years. It's a paper written by, I think it was a local CPA. It's called Doing Business in New Mexico. I'll get that link sent out to you as well. It's a little bit dated, but it's very helpful, and some of the core principles are still there. It talks a lot about gross receipts tax, how you register for that. It goes into more about like the entity choices. So it's helpful in terms of background information that might be on point with where you're at in terms of your business formation. Okay. So I just want to mention that to you. That'll be coming. Okay, so in particular, I want to go into this issue, choice of entity. So some of the contributing factors that are underlying this choice and when there's differentiation is one thing would be funding source. That can make some difference in terms of what the proper entity choice is to begin with. Another thing would be the number of investors involved. That, again, this is expectational, how you're thinking about how you're going to ramp this up. Another issue would be, do you expect to have any need for special allocation of income and expenses?
What do you mean by that? Can you give an example?
Sure. So what I mean by this is there's specific rules about these different entity types from a tax perspective. Where I'm going with this would be a partnership. If you set up your business as a partnership where you have multiple investors who are acting as partners, what you're allowed to do is you can set the economics of the transaction to affect what you're in accord with what you're trying to do. So for instance, if one of the partners is putting in all the cash and the capital to get the business started, and the other partner is going to be doing all the work and the services, well, you can structure it where that one person is getting like maybe a special rate of return who's putting in the capital, and the other one maybe gets more of a profits interest based upon how well the business does. I'm not sure who asked the question. So does that kind of make sense?
Yeah.
So if you need flexibility in terms of how you segregate out the risks and rewards, there's only one entity that'll work to do that. And that's a structure of tax as a partnership. You can either do through an LLC or you can do through a real partnership.
It's a true partnership, right?
Yeah, it's got to be a partnership. You can't do it through an S corporation because S corporation does not allow you to split up income and expenses in any different way across the holders. You have to split everything up in accord with their ownership in the business. So it's easier to account for, but it's more restrictive in terms of what you're allowed to do.
LLC, and then I missed the second word that you said. Was it corporation or was it specialty corp or one of those words?
Well, let me write those up here in just a second. So I'll do that, and then I'll start at that level about what we're talking about in terms of entity types. The last general point I wanted to make on this and contributing factors would be if the business, if you're thinking about if it's a profit or a not-for-profit. So I think that's something probably isn't talked about much, but it may get a little short shrift, is a lot of New Mexico's economy is entities that are structured as nonprofits, right, where the mission isn't so much to create a return for the investors, but to meet some sort of social mission or goal. But again, it falls in the same realm. If you want to start a not-for-profit, you have to use the proper structure and entity type to make that work. So if you go out to the Secretary of State website, what you're going to find in terms of what's available there in terms of mechanisms to do business, and entity types, you'll find limited liability company, which is LLC. You'll find what's called, like a true partnership, where you set something up as your business is a true partnership if that's the route you go. And number 3, another possibility is you can incorporate the business. If it's incorporated under state law, then for tax purposes, it's really only got 2 possibilities. You can make a further election if it qualifies to treat it as an SCorp, or if you don't make any further election, it gets treated as what's known as a CCorp for federal tax purposes. And so we'll talk through these different possibilities. Probably for you all, I would guess this would be the most applicable entity structure would be the LLC. I mean, many of you may already have these set up. So this may be review, but let's go into some of the overview of the tax implications of this. Okay, there's something called a Singlemember LLC. So the owners of LLCs are known as members, right? Partnership or partners, corporation and stockholders, shareholders. But in an LLC, the owners are the members. If you just have one member, one owner of the LLC, the default status for tax is that if it's a single member LLC, the default is it's treated as a disregarded entity for federal tax purposes.
Meaning all the income goes through your personal taxes?
Exactly. It's treated as if it's not even there for federal tax purposes. So if you're running this as an LLC, single member, if you're holding this individually like that, it would go on your Schedule C on your 1040. It's treated as if you're a sole proprietor directly holding that business without an entity in between. So that's what this means, disregarded status, disregarded entity. So that's part of the reason this is so popular, right? Because an LLC is established under state law. They're all pretty much the same across the U.S., the different provisions relative to this. But it gives certain protections and benefits under state law, namely liability protection. But for federal tax purposes, it's treated as if it's not there. So you get kind of the best of both worlds. You get some state level liability protection. From the federal standpoint, it's the same as being like a sole proprietor, but without that direct liability you might incur as if you didn't really have an entity in that place.
What if there's a multi-member LLC? Is that the same thing?
No, a multi-member LLC, actually, multi-member, the default is it's treated as a partnership.
That's important, I think.
So,
Do I need a partnership agreement or otherwise?
well, and I would encourage you as a member of the accounting profession to not do all this on your own. I mean, if you're really getting to the point of being complication and well, it's helpful to get the CPA involved, your accounting help, to get this set up and done properly and on the tax side. Because yeah, if you do something with multi-members and you got an LLC, if you don't make any further election, well then the tax implication is you've got to file a 1065, Form 1065 with the IRS, because it's going to be treated as a partnership. And you got to track who's getting allocated what. Yeah, it just gets more complicated.
Can an LLC with a married couple as members in the state of New Mexico be considered as a sole proprietorship or a single member?
Yes, yeah, there's an IRS ruling to that effect.
Is that in New Mexico or is that all over the states?
I'd have to look to see if it just applied to community property law states or common law states as well. But I know in New Mexico.
Community property or
We're community property.
Okay.
Yeah, so then you get that marital community is considered to be the single member of the LLC.
PLLC, single member kind of option as well.
Does a multi-member? Yeah, if it's a single PLLC, if it's a single member, it would be the same treatment. Yeah, it would be disregarded if it was a successful member. Let me go here first.
On the single membership, you mentioned limited liability.
Uh-huh.
If the company you create finds yourself liable for more than the value of the company, does the liability protection extend to your personal property? That you're protected if you're the owner of that company?
So the question is like, does
You
the,
mentioned limited liability. What do you mean by
like, what's the
limited
limitation on the liability in terms of if the debt is more than the, basically if this entity is bankrupt?
liability?
You know, I would say yes, but again, it kind of be a little bit outside the scope of where I go today. You'd have to consult external on the law side with that, but that's the idea. As a general principle, is providing protection from your personal assets away from the business assets.
I have an LLC where a business accelerator owns 6% of the company, but I still get taxed as though whatever wasn't spent in the LLC that year was like went directly to my bank account. You know what I mean? And I was really surprised to learn that this year. So I was going to ask what the distinguishing factor would be between a single member LLC and a partnership.
Well, I mean, on the face of what you just described, so if the accelerator owns 6%, you own 94%. I mean, what you're going to get taxed on would be any net, not just you in total, but the total tax of the whole entity would be the net income from operations. So the revenue minus the expenses. I mean, there's no tax on capital contributed or debt or anything like that. So it's got to be positive income creation. But that said, you know, so it's got to be from operations. So if you actually have profitable operations, it surprises me to hear that a little bit. I mean, I would think that 6% would go to the accelerator and 94% would go to you, just under the default capital interest ownership from what you're describing within that LLC.
I'll talk to you about it afterwards.
Okay, but that may be something, but that would maybe go to the agreement that was formed on the front end. Because that agreement, whatever's formed on the front end, I mentioned earlier about special allocations and who gets taxed on what. The agreement that you go into with your other investors in a partnership setting, that's going to control who actually gets taxed or who gets the benefit of deductions and so forth. I see another hand. So an LLC, yeah, obviously very popular, single member, default is disregarded. Couple comments on that. So I mentioned this, if you have a single member LLC, some fashion is going to be treated if it's owned by an individual as a sole proprietorship. So where I'm going with that is it's subject to both. Be subject to both income tax as well as self-employment tax. I'm not seeing too many surprised looks on the face of everybody. That's good. So which all adds up, right? I mean, it's a good thing if you're profitable. I mean, that's what you want, to be making money. So that would be treated, that would be taxed at your regular personal marginal tax rates, married filing jointly or single, if you're single, head of household, whatever it is. And then the self-employment tax would accrue to the person who's considered to be the owner of that business. So that's, if you're not familiar with that, this is the piece that covers for someone who's operating their own business, similar to an employee paying their FICA. This is what's covering Social Security, Medicare, Medicaid is the self-employment tax. So that's the two things. You got employment taxes, you got income taxes. If you're running a sole proprietorship, you have to cover both. So the bad news is your marginal tax rate between those two can get upwards of 50%. goes up pretty high pretty quickly.
But you're not talking about an LLC anymore, you're talking about a sole proprietorship.
Well, I am talking about an LLC, because an LLC, for tax purposes, is treated, if it's a single member, as a disregarded entity. So that income goes on your Schedule C as if it was not there. So for federal tax purposes, you are treated as if you are self-employed, even if there's an LLC that's the structure of the business.
I was shocked at how much I had to pay in taxes this year, given how much I made and how much we made. Really shocking. Do you think it's shocking as a small business what we pay in taxes?
I think it's shocking. I always agree.
What if you have more than one LLC?
What if you have more than one LLC?
So your self-employment tax would be, what if you're paying Medicare, Medicaid, and all those other extra taxes, Social Security, on some other paycheck, not from the LLC income?
Well, this would be something to talk with your accountant about. But if you have wage income from another job, so like I work at UNM, if I'm running a business on the side, there's caps on how much is subject to Social Security. It's like 130,000-ish, something like that. So if you have enough income from your wages plus the income from this business, those are integrated together on the 1040 in terms of how much more you have to pay. So that, if I'm making 100 grand from UNM and I make 50 from my business, I would cap out at 130 on the Social Security piece. And then once I get above that, then I'm not paying any more, even on the self-employment tax side.
Okay, thank you.
So they do integrate together. Other questions on this?
Is there any major significant reason to become a sole proprietorship?
Well, I think at the root of this, in tax, when I'm talking in the class areas, you don't ever want the tax to wag the dog, or the tail. So I think you first look at the substance of what are you trying to do. That's why I put those factors up at first, like what kind of funding do you need? What kind of other people do you need to bring in or not bring in? Where are you trying to go? How much control do you need? So those factors kind of driving what's the proper entity choice in terms of what you're trying to accomplish in your business. So if you're doing a consulting business, if you're doing one person, well, then you probably are going to set up a single member LLC with your consulting business in it. And if you're working from home, well, that's great. And you're just treating this effectively as a sole proprietorship. But if you have to have partners, well, maybe still use an LLC, but it's not treated as this because then it's multi-member. So then it goes into a little more complication under the partnership rules.
Mostly answered it, and I think what I see of people wanting to fund other people's business and accelerators and all kinds of cool financial arrangements, and I'm guessing that people do one of those partnership agreements every time, even if they are an LLC, because otherwise you may end up at the end owing somebody money out of your personal. Supposedly you're not supposed to ever be liable with an LLC, but I just got to thinking about whether you ever could end up being liable.
Well, if I understand your question right, there's different types of liability or different sources of liability.
Right.
If you're talking about from like a tax perspective, which is what I'm talking about today. So if you're talking about like if you have a profitable business and you have multiple partners within that profitable business, you get taxed on the income whether or not there was a distribution of the cash out to your level.
That's what
So that's probably talking about as like a form of phantom income where the money may be retained within the business, but in that type of entity, you still get taxed. So then you got to come up with the tax payment from other resources.
Yeah, isn't that strange? Isn't it strange one? Then two, are the other corporations, like the other entities, set up that same way? Like, it's so, when you see, like, for example, what Amazon pays in taxes versus what a small business pays?
Yeah, that's a perfect example right there. Or I think I know someone in a food business that, they didn't really write one of those agreements, so they ended up losing their food truck.
LLC versus corporation.
Right. Yeah, that's what you are getting into, strengths and weaknesses of partnership or LLC versus a corporation.
Okay.
So either way, in an LLC, if it's single member, you get taxed directly because it's disregarded, so it's treated as sole proprietorship. If you have a multi-member LLC, you get taxed immediately because it's a flow through of any net income down to the partner level. So there is no deferral by having it up in the entity. Plus, in a partnership, that is a potential weakness that you should figure out up on the front end in terms of the agreement is, there may be a recommendation in there is if you have income within that there's going to be some sort of set amount of distribution, as many businesses will distribute a certain amount of cash to help their partners pay the tax. Does that kind of make sense? Because otherwise, if you don't, then you're going to have to pull the money from other sources to pay the tax that you're getting on this flow through. So let me talk just a little bit about the corporation. I know this is obviously a lot, but I just want to throw some of these things out there to be thinking about. Corporation, I mentioned you go to CCorp or an SCorp.
Greg, are you going to talk about a B Corp too?
I can.
Does that status yet exist in New Mexico? I thought it didn't. B Corp.
I'm not sure if and some of the material they put out there talks about that. I mean, that's someplace I came across. I'm not sure if we have formal B Corps within New Mexico or not. From a tax standpoint, it doesn't really matter because B Corp sense is almost like a certification. It's like in terms of your sustainability about how are you doing business? Are you doing it in an ethical manner? How are you like that, etc. So the government doesn't really care from a tax perspective. So a B Corp would really end up being an S Corp or a C Corp. But that's almost like a different layer on top in terms of how its operations are working. But the actual income generated from this are going to flow out in one of these two ways in terms of the taxation. That'd be interesting. We just had a seminar at Anderson on B Corps. Had a lot of really good people come participate. Like Matt Wolf and who else? Bueno, all sorts of really good companies. There's another. Yeah. Well, so going into this a little bit, C Corp. If you set up your business and you incorporate it under state law, the default status for a real corporation. I say real because you've incorporated it. It's got state law status as a corporation. If you don't make an election beyond that, it gets taxed as what's called a C corporation. And what that means is that the revenues and expenses are aggregated within that business, and the tax is paid at the corporate level. So that's generally, if you've heard how many levels of tax are there in a corporation. If you have C Corp, the traditional way of looking at that is that you have two levels of tax. You have a tax when it's earned because the corporation is a tax-paying entity. And then if you distribute it out to the owners, that's what's called a dividend, and it gets taxed again. So you have two levels of tax. I would go out on a limb and say, well, if you look at IRS data, this is true. Most small businesses do not set up as C Corps for that reason. But I caveat that some, just because with the tax law change in 2017, that's changed somewhat of those dynamics. Because now the top rate for corporations is 21%. So the corporate tax rate was dropped under that. So if you combine that with maybe taking wages as the owner, yeah, you can take a salary, which is a deduction for the corporation. There's ways in which you can kind of do those in combination, which reduces this tax liability at this level. So that dynamic point is changed somewhat, so I don't want to say, oh, you never do that. Depending upon circumstance, it could be right, but usually it's not.
I don't understand the taxes on the dividends. Does that mean the person who receives the dividends pays the tax on receiving the dividend? Or does that mean there's an additional tax on the dividend before it's paid out to the owner of the stock or whatever?
Well, it means that, so say you have the corporation, C Corp. So you have that type structure. So you have the C Corp, and they have the owner, the shareholder down here. So if the business is being done through the C Corp, so you're aggregating revenues and expenses here. So if this is generating a profit, the 21% tax rate is paid there. Then the net profit from here, if those dollars later are distributed down to this owner, that distribution is a dividend, and that gets taxed again. Well, not again, it gets taxed at this level when you distribute the actual earnings out to your owners.
It's the owners who are gonna pay the tax.
Well, there's two taxes. The corporation pays the first level, and the owners pay when it gets distributed down to their level. Yeah, question?
What would be a primary reason to be a C Corp? I would want to be a C Corp.
Well, that's what I was saying. You really usually won't in a small business type startup setting. It'd be more, it's hard to make oversweeping generalities, but usually an S Corp, if you go the corporate route, would be more appropriate.
Unless you take venture capital money or some other kind of investor money.
That is a very good point.
That's it, yeah.
I thought of one other one. My brother set up his whole family finances and some kind of plan where when he dies, it all goes in dividends to all his heirs. And they set this up when he set up a radio station he owned with a bunch of partners. And because his dividends went into that other, does that make sense? It was an accounting nightmare, but he hired someone. But he did it because, you know, his life expectancy right now, maybe 5 to 10 years.
Yeah, and there's,
We're older, a lot of us are older, so that's why he did it.
and that's, again, where it's here, it's kind of hard to overly generalize because it's very situationally contingent. And I guess one generalization is saying in terms of your revenue expenses, that it's worth probably hiring somebody who knows what they're doing on the front end, especially if you're getting more complicated. And like to Lisa's point, you know, I mentioned way back at the beginning about like, you gotta look at the type of investors and so forth. But yeah, you're right that private equity, they may only invest in C Corps. They may force that business to have a certain entity structure because that's the game that they play. That's the way they do it. They invest in shares of stock, you know, and so that may drive your entity choice. Or if you had like a sole proprietorship, if you want to open up a new opportunity for new funding, you may have to convert from being the sole proprietor. You may have to put your assets into a corporation, create that entity to facilitate the ability to do that type of deal.
What's the difference between C Corp and S Corp?
So the difference between a C Corp and an S Corp is the biggest thing is C Corp has a tax at the corporate level. Okay, so C Corp, 2 levels of tax. Corporate level, 2nd level of tax when distributions are made to the owners. Or alternatively, when the owners sell their stock. Then they get taxed on the capital appreciation. So it's kind of the same thing. Well, I don't need to erase all that. Say this is an S Corp. The way this looks different is if it's an S corporation. So say here you have the revenue and expenses, you have a profit within the corporation. There is no tax at the corporate level. The income flows out to, so there's no tax here, nothing there. This income flows out to your owners in proportion to what percentage of stock they hold. So you get, if you own 50% of the stock, you pick up 50% of the profit. If you own 20% of the stock, you pick up 20% of the profit. There is no flexibility in that. You have to do it in terms of your ownership percentage. Whereas in a partnership, you can split things up differently if you want to. There's more flexibility in a partnership, but it's a lot more complicated to track. Whereas this has a lot less flexibility, but it has that same attribute of being a one level of tax. So this gets taxed at this level, at the owner. But that raises that point we were talking about before. If the profit is retained up here, so you just reinvest the money in the business, you're still taxed on your share of the income. So it's the same thing as in a partnership. It's kind of a phantom income approach where you get taxed whether this money is distributed or not. If you need some money to pay the tax, well, again, you'd want to maybe make sure that's clear up front. Have the SCorp distribute enough dollars to help you pay the tax on your share of the flow-through income. Does that make sense? Questions on that? So summarizing a lot, I'm kind of going through this quickly. Partnerships and S-corps are very similar in terms of the way the taxes work. Partnership, you have a lot more flexibility in terms of what you're allowed to do, but it can be more expensive to run because you have to have more accounting time, you have to have more record keeping, so forth. S-corp, again, you have the flow through, but you don't have as much flexibility because you have to divvy everything up based on the ownership percentage of the shares. That's it.
What's the percent tax on the shareholders' income? Is that dependent upon their personal income?
That's dependent upon their personal income.
So it's going to be something like 30%.
Yeah, give or take 30%.
I think my challenge as an LLC owner is tracking expenses and subtracting them from income tax and all that. It's not possible for me to do it without a profit, whereas if I had set up maybe a corporation, I might have been a little better off. I'm going to have to close the LLC because it was set up wrong.
Yeah, well, and the proper entity choice, it can change over time.
Right.
At first, if you're losing money, that's, which isn't unexpected, right? I mean, as you're ramping up the business, maybe you expect that it's going to be negative for a while until it reaches profitability. Well, in that sense, you definitely want to be able to use that loss maybe to offset other income that you have. And you'd want to take that into account in the way you set up the business. Down the road, maybe circumstances change. You have new investors, you have something else. You might want to look again as to what's the proper way to structure it. Yeah, question?
Can an LLC elect to file taxes as either a corporation, an S-corp, or a C-corp?
It can.
Either one?
Well, the way it looks, which is kind of interesting, is if you have an LLC, these are the default statuses that I went over. So that implies if you have default status, you can actually elect out of the default status into something else. So you can file a form with the IRS. You can what's called check the box, which is checking the box to elect out of the default status. You can elect into having it treated as a corporation for federal tax purposes.
Would that be a C or an S?
Well, that's a great question. So step one would be, if you don't make any further election, that would be a C. And then you can make election number 2 if you wanted to, if it qualified. Because there's to be an S-corp, there's certain qualifications. You only have a certain number of shareholders. You have only a certain type of shareholders. It only can be individuals. If it qualifies, then you can make a second election and have it elected under the IRS treatment as an S-corp. Or then it becomes that flow through. Now, why would you do that? I mean, probably why you would maybe take that path would be something along the lines of simplifying the accounting would be one big reason. Because this would result in flow through results, but you don't get into all the complication that you can run into with a partnership in terms of tracking who got what and what percentages and so forth. So it's not as flexible, but it's a lot easier to track. And i.e. it's probably cheaper when you're going to your accountant.
Would it make a lot of difference if your organization had a lot of assets or inventory?
It could, Again, that's one of the things here. I mean, what we can say here in generalities. Again, I think it goes back to my comments initially. Like, what are you trying to do? What's the business? And then at that point, I would say, I mean, if you're putting that much assets in, I mean, it's probably worth getting quality help and assistance to get things set up right. You know what I mean? If you're putting a lot of dollars in, well, no matter what you're doing, but I mean, consulting is probably a lot lower risk in terms of how you're structuring things than if you're doing a lot bigger dollar value business.
I never understood if you're an LLC and you elect to file as a C or an S, why wouldn't you just be a C or an S? What's the advantage of being an LLC?
It's like, no money to set it up with Secretary of State's office. That's why everyone in my accelerator did it.
So everybody's kind of, that's the playbook. You do it that way. That's
Right,
what,
and I'm gonna urge people in here to be really careful about letting others kind of set them up. I'm a Colorado resident and I own a New Mexico LLC. That is not helpful for me at tax time. You know why?
why? What's,
If I were making any money, it would be like major headache. I want to say, well, why are you a Colorado resident?
well, yeah, you get into those things, state taxation is
Ugly
really,
stuff.
yeah.
They thought they were helping me, but they weren't.
I-
That makes sense? They thought
Well, it
they were
does. I mean,
helping,
there's other unintended consequences that can come up.
but people were helping you.
And we're almost out of time, and I'll send you this stuff out, but I guess one thing I was thinking I want to leave you with is in terms of the corporation side, if you go into the corporate either as an LLC, non-default status, or a true corporation, you got to be really careful because the way those are set is once you put assets in, it's very difficult to get them out without triggering tax consequences. So if you pull them back out, if there's any gain in it, you know, like you put in land, say it's worth 30,000 and that, or you bought it for 30 and it's worth 100,000, you put it into that entity, to get it out, it triggers the gain. You can't take it out without paying the tax. So that's bad, usually. Whereas a partnership or a disregarded entity, you put it in there, you can pull it back out without too much problem. So that's a big consideration, is if you want to unwind things, it's a lot easier to do it through a partnership or a sole.
But it doesn't become a partnership if during your IRS filing, you elect to have it treated as a corporation. Does it become liable to this?
Well, that's where you want to be careful, because if you took an LLC and elected it into corporate status, you elect all the tax consequences that come with corporate status, which means that if you have property that's have appreciation in there, if you pull it out, it triggers the gain. Because if you elect it into it, the IRS says, well, you chose this, that's your choice. You get taxed as if that's.
Is that a year-by-year thing? No, so once you do it, you're stuck into it.
Once you do it, you're stuck.
I was gonna say, the IRS are not incredibly friendly about, oh, gosh. I
No.
made a mistake.
No, not really. It's kind of an assumption that you knew what you were doing, and you know, you sought the counsel that you needed. Yeah, it's just really, it's like you have to live with the consequences of your chosen form is the way they look at it. So, hey, I mean, it's a good takeaway. So here's some thoughts overall, but be careful. You know, if you're getting into complications, seek guidance. It's always helpful. And yeah, thinking about what I'm talking about front-end cash flow, some of those other implications. So I think that's all I have time for.
Okay, great.
And like I said, I'll get that information sent out, and if we can just disperse it.
Contact us and we'll send it to you.
Okay.
I'm gonna do